These huge AI deals keep coming one after another, and skeptics are starting to ask, who is paying for all of this? Where is all this money coming from? OpenAI alone has announced something like $1 trillion of spend on what's called compute, which is data centers and chips and energy and water and all the things that go into responding when you ask ChatGPT a question. And that stuff is really expensive. The problem is that OpenAI doesn't have $1 trillion. It makes somewhere around 10 or $12 billion a year based on the reporting that's out there, and it loses that plus a couple $1 billion. That gap has to be filled by either investors who have been willing to pour tens of billions of dollars into OpenAI as a venture bet. It can come from borrowing, or it can come from kind of Wall Street doing what Wall Street does, which is a bunch of financial engineering trying to essentially use the AI hype to fund the AI hype. When OpenAI announced a deal this week to buy 6 gigawatts of compute power from a company called AMD, that's a lot of money that OpenAI doesn't actually have. What they did instead is they essentially used AMD's public stockholders to pay for it. They knew that when they announced this deal, AMD's stock price would go up, which it did massively. OpenAI essentially bought some stock cheaply, understanding that when the value went up, it would kind of pay for itself. And that's all kind of working right now, but at some point it starts to look a little like the dot-com bubble when you had this huge, really expensive build out of fiber optic cables. And that was largely built by startups that, like OpenAI, didn't actually have the money to build the thing. And it was largely underwritten by companies whose names you've probably forgotten. Companies like Nortel and Lucent, these big tech and telecom companies that ultimately most of them went under in part because they were underwriting this huge, expensive build out that, yes, gave us the internet, but took way longer to pay off and did not pay off for the people who were making the bet. I talked to Todd Lemkin, who's the CIO of an investment firm called Perimeter, which is trying to figure out where to play in this space. And what he told me was you don't have the same dynamic of, he's talking about the dot-com bubble, where if the music were to stop, these companies would fall over. He notes that they don't have a ton of debt. They have some wiggle room on, they could borrow to fill the gap. And their shareholders seem pretty okay right now picking up the tab. He says that's important, but for the first time, 3 or 4 years into this, people are talking about it and they're starting to question it. Tap the link in our bio and sign up for Semaphore Business.